Everyone is saying SIP is the ultimate wealth building machine. But here is the truth. Long-term portfolio returns are not just about discipline. They are about valuations at the time of entry. So if you're blindly sipping into a fund forever, you're ignoring the single most important driver of your returns, what you're buying and when. So here is a very fascinating under-talked insight. Look at this chart from Funds India. Green indicates highest return, white the second highest return, red is the lowest. Let us say as an investor, you are wise enough to know what is the market bottom. Now, if you had invested in the mid-cap fund or the small-cap fund at the market bottom, your returns would have surpassed those from the Sensex, that is large cap, and by a very good margin in many cases. For example, if you had invested on this market bottom day in a mid-cap fund, you would have beaten the large cap by a huge margin. Very similarly, again investing in a small cap fund during the market bottom here would have delivered a much higher return compared to the large cap. On the corollary, if you had invested before a market bottom, let us assume you invested 6 months before the market hit a bottom, then your mid cap and small cap funds did not beat the large cap funds majority of the time. In fact, while investing during market peaks, it is the large caps that have offered more returns than the riskier mid cap and small cap many times. In fact, no single index consistently remained an outperformer when you invested 6 months before the market bottom. This is in contrast with what happens when the investment is done at the market bottom, because investment in a mid cap or a small cap fund at the market bottom outperform the Sensex, that is the large cap. But then that can only be achieved if you have invested at the market bottom, and there is no way of knowing if you are at the bottom except in hindsight, that is after it has happened. So what matters more is when you buy them, not just what you buy. Therefore, valuation timing is a very powerful lever. Entering small caps at the peak valuations can undercut returns, whereas late cycle large cap investments may yield similar long-term results. This ties to the concept of this video, which is tactical SIP. Let me show you two very interesting data or case studies. It was an eye-opener to me when I first saw that. First, 10 years returns of all these categories more or less are converging to the same return. For the decade ending 15, 10-year returns of all the three categories was around 17%. For the decade ending 20, 10-year returns of the small cap was much lesser than the large cap. Mid cap return was similar to the large cap return. And the 10-year return ending for this decade, small caps and large caps are converging. So combine this with another chart. A particular market cap fund underperformed for 3 years in a row. Underperformed for 3 years in a row. But we typically do an SIP into a category after it has become the best return generator. So we will go into a SIP category when they are in the green, and then the performance can go into red. Now flip this around and see if you do a multi-year SIP in a category when it is red, and then next few years they emerge the best in green. On the corollary, correction in mid cap and small caps of 1920 could have driven lower SIP investing into those funds in your buy and forget SIP portfolio. So not rebalancing the SIP choices especially will lead to adding risk. It reinforces that blind SIP into any category, especially the riskier ones like the mid and the small cap, can be suboptimal if the valuations are frothy when you start. The smart path is to continue your SIP with discipline, but rotate the funds based on valuations and the risk-reward ratio. Pause your SIPs if it is in an overvalued category. Shift them into those that are undervalued regardless of market cap. While SIP should continue, in what you are directing your SIP to what funds, that is very contextual, and you need to revise it, reevaluate it regularly. The real game changer, therefore, is not the fund category, it is when you buy them. This valuation aware SIP wins. This debunks the category myth that small cap SIPs are always a runaway success. It emphasizes a valuation based timing SIP as a smarter strategy. Blind SIP strategy is being replaced by Valuation-Smart SIP. Here is something most investors would have never heard when it comes to SIP investing. Your returns just don't depend on how long you stay invested, but when those returns actually come to you. This is called sequence of return risk. Let me explain with this example. There are two investors, both invest in 1000 rupees every month for 5 years. Both end up with the same average return of 12% CAGR, but one of them started the SIP when the market was cheap, say 2020 after the COVID crash. The other started when valuations were very high, like mid caps in 17. The result, investor who started in 20 saw money almost double in 3 or 4 years, whereas the other investor who started in 2017 barely broke even after many years of compounding. Even though SIP is supposed to average things out for you as an investor, the order in which those returns show up makes a decisive difference. This is why blind SIP, putting money into the same fund forever without looking at valuations, is actually risky. Smarter way is what I call the tactical SIP framework. Every year or two, check the valuations. If an asset class is too expensive, pause SIPs there and redirect them into areas in funds that are undervalued. That's how you protect yourself from sequence of return risk. And this is also why I say SIP is not dead, but blind SIP is dead. Smart SIP is the future. The other point is, understand before starting your SIP, it is to know the standard deviation of the fund that you are investing in, about the category that you are investing in. Standard deviation tells you by how much your returns will actually vary. For example, if your average return of a fund is 8%, a standard deviation of 10% would, on an average, deliver returns -2 to +18%. That is 8% average return plus 10% or -10%. A higher standard deviation would increase this range and thus bring in more significant risk. Everyone tells you SIP is a very simple product, just start and forget. But markets are not that simple. Valuations move in cycles, and history shows us that these cycles, they decide our long-term outcomes. Take small caps. In 2007, they were the hottest thing in Dalal Street then. Valuations were stretched to very absurd levels. What happened next? They fell by 50%, 60% in 2008. So a SIP started in 2007 looked like a disaster for years. Something similar repeated in 2017-18. Mid caps and small caps were trading at 50, 60 PE, completely detached from reality. SIPs started then delivered some of the worst 5-year returns later. On the other hand, an investor who began his SIP journey in March 2009 or during COVID 2020 April, right after the crash, saw extraordinary wealth creation, the same SIP product, but two very different outcomes. The difference, that is the entry valuation. This is just not an India story. In the US, Nobel laureate Robert Shiller created the cap ratio, cyclically adjusted PE. Data shows that cap is high, future 10-year returns are poor. Whenever cap is low, the future returns are outstanding. The same principle applies in India as well. Nifty PE above historical average leads to muted next few years CAGR. So valuation at the time of entry is just not noise. They are the foundation of your compounding portfolio. Let us wrap this video by looking at 3-point practical checklist. 1. Track your valuations, PE, PB, dividend yield of the indices. 2. SIP rotation rule. Every 1 to 2 years, redirect your SIPs from overheated funds to undervalued funds. Third, check the risk score, standard deviations, maximum drawdowns of the funds before committing. Now, let us add human behavior into this mix. Investors suffer from recency bias. When small caps flash green in the performance charts, money flows in. This ensures people are buying at peaks. When the cycle turns red, fear takes over and SIPs get stopped right before the rebound. That is why most investors underperform the very fund that they invest in. So the problem is not the SIP itself, the problem is how people behave around SIP. If you like the content of this video, please hit the like button. Please consider sharing it with your friends and subscribing to this channel.